It's time to cover Chapter 10 in our personal finance class. This one's not the most fun chapter to cover, but it is really important for us to learn about. So let's jump right into dealing with life insurance. So, first of all, what is life insurance? You're probably wondering. And overall, it is money that is going to be provided to your loved ones after you pass away. So, this can be money to cover lots of different things that they may face and will help them out during this very challenging time in the event of your loss. So, important things to remember when it comes to life insurance. We want to budget for the premium. So, we've learned in other chapters that the premium is the amount that you have to pay in order to keep that insurance active, in order to keep that policy. So, you want to make sure that you have the money for that. Sometimes the premium for life insurance is paid once a year, other times it's paid once a month. In fact, for me, I pay life insurance once a year. My husband pays it each month. So it just depends on the way that it's set up, and make sure that you budget for it so that you don't lapse in that coverage. You want to research what are different things that I'm looking for life insurance for myself, and I want to compare different prices at different companies. And I'm going to show you throughout this chapter how you can know an estimated amount of how much you might want to have in coverage for your life insurance. And we also want to be able to name one or more beneficiaries. So that is going to be the person or the people that receive the money in the event that you were to pass away. So a beneficiary a lot of times is your spouse, children, could even be a charitable organization. So we'll talk about that more in just a minute. So, what is the purpose of life insurance? So, typically it's going to be used to pay for the mortgage or other debt that you have. So, for my husband and myself, we're like, yeah, if one of us passes away, it'd be really nice if we could go ahead and pay that mortgage off so that you don't have to worry about trying to make ends meet in that event. It could also provide a lump sum of payments through an endowment for children at a specified age. So, what this means is that, okay, maybe you've got really young children and you say, once they are at age 25, if I pass away when they're 10, I don't want to just give them $500,000 at that point. But once they turn 25, it would then be provided for them. In the meantime, there would be some money provided for whomever is going to be taking care of your children. But instead of handing a 10-year-old $500,000 or whatever amount you may select, you want to wait and put it in an endowment so they'll receive it when they're an adult and hopefully can make wise decisions with that. We could use that money to provide an education or income for your children. That's another thing my husband and I considered. We said, let's set aside enough money that we could pay for their college. So if I pass away, my husband doesn't have to worry about the mortgage or paying for the kids' college and vice versa. It could be to make a charitable donation. Maybe you say, I really would love to be able to help out this organization, but I just don't have the means to do so. But in the event of my passing, maybe I could leave behind a significant sum of money for this church or any other type of charitable organization that you want to support. So that's another option. It could also provide retirement income for your spouse or for your children. So you could have that income set aside for them. So these are some of the things. Sometimes people are using it now to have generational wealth. I was never able to accumulate enough money to be able to pass down to my children to make it significant. So my parents didn't leave me anything. Their parents didn't leave them anything. But if I have a significant life insurance policy, at least I can leave my children something when I pass away. So whether that's the right way to go or not, that's up to you. More importantly, I believe, is to teach them about how to manage money. But if you want to be able to leave them some money through a life insurance policy and teach them, then that could be a good combination to choose as well. So totally up to you on how you want to do that. There's a lot of questions when it comes to the insurance. So how much do I need? And we're going to talk about that throughout this chapter. How much longer am I expected to live? So obviously it will vary, but there is a chart that shows the expectation of how many years that you're going to live based on how old you are now. So I am slightly above. I'm 37, so a little bit above what the chart here goes to. So that's depressing. But you see, males don't typically live as long as females. So you can look at your current age and then go over. And so if I were 35, if I were 2 years younger, then I'd be expected to live another 47 years. But things happen and I may not live another day. So, it's good to have life insurance in place in the event of something happening. How much insurance do I need? So, we're going to talk about that. And is my employer offering coverage? So that's definitely something you want to find out. A lot of employers offer, a lot of times it's 1 year's salary that they would offer to your loved ones in your passing, and then they may offer extra coverage if you pay for it, and typically that's very inexpensive. Now there's usually a limit, so you can't do too much, but you can typically cover yourself for several years worth of salary, your spouse, and even your children for very low amounts. So we will look at some different options to see how much coverage that you're going to want to have, and then you can compare that to what your employer will offer. So the first one is the method that we want to see in our homework problems, the easy method. So with the easy method, we just take our current annual income times 7 years times 70%. So basically we're saying with this easy method, we want to provide our loved ones 7 years worth of our income. Maybe it's not all of it, but at least 70% of that. That gives them time to get back on their feet. Maybe it gives them time to pay off some things, to get everything in order. So this would be the easy method, the annual income times 7 years times 70%. That could be one really quick way to determine how much insurance you might want to have on your life. There's also the DINK method, dual income, no kids. So here you've got two people making money, but we don't have any kids, we don't have any other dependents on us. So in this case, you want to cover all of your funeral expenses and then half of any debts that you have together. So an example here, we've got funeral expenses of $5,000, which is very, very low, by the way. Funeral expenses are closer to $10,000 or even $15,000 for a nice funeral. So then we have half of a mortgage, half of an auto loan, half of credit card balance, half of any personal or any other debts. And that's if the two people, the dual income, are sharing this debt. I'll at least pay my half off so that you don't have as much of a burden on you. I don't want everything to fall on you after I pass away. And if you know Seinfeld at all, George Costanza pretty adamant about not spending more than his share. So I thought that this little meme was very appropriate from one of the Seinfeld episodes. I know it's a really old show, but it's really funny, so you should check it out. So then there's the non-working spouse method. Now, does someone who doesn't even bring in an income need any life insurance? And I would argue, and your book would argue, that yes, they do still need insurance because they are bringing something of value to the table. And you have to consider that people who are staying at home, stay-at-home spouses, especially with children, they are probably going to be cooking, cleaning, providing child care, providing transportation costs, all things that would be very expensive if that person were to pass away and you have to replace them. So, for that reason, this non working spouse method is $40,000 a year that would need to be calculated based on the age of your youngest child. So you take 18 minus the age of your youngest child. So basically, how long am I going to have kids at home before they go off to college, or at least maybe start bringing in an income? How long do I have those kids at home? And then you multiply that times 40,000 a year. So if your youngest child was 8 years old, you take 10 years, because it's 18 minus 8. We've got 10 years that we still expect to have kids at home that are dependent on us, times the 40,000. So we would want to have 400,000 in life insurance, even on a non-working spouse, so that we could pay for all of these services that the non-working spouse is offering, because they do bring a lot of value to the table. Now, this method is probably the best one to use, the family need method. So this is really looking at your specific family. This is more of what my husband and I did. We took 5 times personal yearly income. So you'll be able to provide that for your family for 5 years. Total approximate expenses above and beyond your daily living costs. So this could be things like paying for college. It could be things like going on vacations. So we want to, maybe even marriages, for your children. So you want to be able to set money aside for those things as well. You want to make sure you have an emergency fund set up. So those 3 to 6 months worth of living expenses. You want to have estimated funeral costs in there, and then subtract out any assets that you already have, any cash you've already got on hand. So maybe you calculate all this, you say, this is $600,000. That's a lot of money. But we already have $100,000 in cash, so that leaves us with $500,000 we would need to get in life insurance. Because if you've already got some of it in cash, you don't need to have that in life insurance. So those were the different methods of calculating how much you want to have for insurance. Now let's look at different types of insurance. So there's 2 main categories. There is term life insurance, which is also known as temporary life insurance, and then whole life insurance, also known as permanent. There are many different kinds of insurance that fall within those categories. I'm going to touch on them a little bit. You can look at them more in your book, and there's even more than I have listed here. But with overall, the big picture with term life insurance is this is something you have to keep paying for on a regular basis, and the price is set for a short period of time. For my insurance, I have term life insurance, and the premium is set for 10 years. After the 10 years is up, I then have to be reevaluated, and I'll have to pay more because I'm 10 years closer to death regardless of what has happened to me. So the good thing about term life insurance is it's less expensive than whole life insurance, and we're going to see why that is in a minute. But with term life insurance, it's less expensive, so it's fantastic. But if anything happens to you, you have a heart attack or you develop any kind of health issues during that time span, when it comes time to renew it, they're going to say, wait a second, you now have this and this and this going on, and you're 10 years older? Oh, wow, we are really going to bump up your premium. So as you get older, it gets bigger and bigger and bigger to have the coverage. But, as you get older, hopefully you're paying off a lot of your debt and you're getting closer to retirement, and maybe you don't even need quite as much insurance. So that's something to think about as well. So then we have the whole life insurance, also known as permanent life insurance. This one, you can get in on this in your early 20s, and you'll have a set amount that you pay. You continue to pay that premium for the rest of your life as long as you don't cancel or lapse on that insurance. So it's high for a 20-year-old, but it's low for a 60-year-old because the 60-year-old's obviously much closer to death and has most likely, brought on different health problems throughout those years, but that price was set when you were young. The issue here is it is much more expensive than having the term life insurance. One other positive is there's a cash value aspect to it. So some of the premium is actually being set aside into an account that if you were to cancel the policy, you could take that cash out. Now, if you pass away, then that cash amount the insurance company keeps, and then the total amount of the policy would just go to your loved ones. Personally, I would go for the term life insurance. That's what most financial advisors would also recommend. But then I've talked to students who say, no, I am all about the whole life insurance because I had this big health issue happen and now I can't get life insurance. Because a lot of times if you do have a significant thing happen like a heart attack, no one's going to cover you after that. So that's something to consider. But you really have to weigh your options. Just make sure that when you take the advice of someone, that if they're trying to get you to choose whole life insurance, consider if they are going to be getting a commission from that. So, heed their advice only if they're not just fully benefiting from you. So that's something to really consider with whole life insurance. All right, last thing I want to talk about in this chapter is annuities. You may remember the word annuity way back from chapter 1, and we've used those tables, those present value of annuity, future value of annuity tables throughout other chapters as well. But when you hear someone talk about a financial instrument that's called an annuity, what they're referencing is an account that will be used in your retirement. So this is where you put money in, maybe it's a lump sum when your great uncle dies and you're 30 years old, he left you $500,000 and you're like, what do I do with this? And your financial advisor says, put it into an annuity and we'll set the money aside, we'll invest it. And then when you turn 65 or whatever, you'll start getting regular payments. So it's like a set amount that you're going to get once you retire every month for the rest of your life. And it's all based on how much you put in, how long it has to grow, and how much interest and everything it can earn. There is going to be commission earned on that, a significant amount of commission earned from the financial advisor that recommended that you do this. So you have to be very aware of that. It could also be an immediate annuity where you put money into it, at 65, and then they invest it and you start taking it out for the rest of your life. The main advice with this would be you need to fully fund all other retirement accounts, so your 401k and your different IRAs, before you even consider an annuity. And again, remember that a financial advisor will be making a commission off of you. So if they're telling you this is what you should choose, are they doing it for your benefit or for their own? This is not something that I personally or my husband have chosen to get into, and most financial advisors that are not making money off of you do not recommend these either, because they say, why don't you just invest your own money and you could probably make better decisions with it anyway. So that would be advice from a lot of the different financial experts that you could research and find. So all things that you have to make decisions about. But just remember, whole life insurance and annuities do have a significant amount of commission that's going to whomever is selling it to you. So I hope this helps with learning about life insurance and these annuity accounts. And even though you may be very young right now, these are things that you want to start considering.